Compare these two charts. Both use the standard 14-3-3 stochastic oscillator. On the daily chart, the setting identifies a clear swing low, but on the 5-minute chart, that exact same math triggers a buy signal only after the price has already peaked. By the time the indicator lines actually cross, the momentum that caused the initial spike has already dissipated. Technical indicators are mathematical filters designed to isolate daily trends. On an intraday chart, those same filters introduce a timing delay that renders most signals obsolete. This %K formula reveals the mechanics of delay, measuring the current close against the previous N periods. Two variables create this lag: N, the 14-period lookback, and the %D line, a 3-period moving average of the first result. Applying macro-level settings to a micro-level environment creates a persistent timing disadvantage for intraday traders. Daily trends mirror long-term fundamental changes. That intraday charts are driven by rapid institutional orders, creating jagged, non-linear price patterns. On a daily chart, a 14-period average filters noise, but on a 5-minute chart, that heavy smoothing flattens actionable peaks, hiding the trade. In this 5-minute market replay, we see a sharp price drop that immediately reverses into a rally. Tracking the %K and %D lines in real time shows divergence. The price has already recovered half its losses, but the indicator values at the bottom remain stationary. The 14-period lookback calculates using data from an hour ago, while the 3-period smoothing forces the signal to wait for a confirmed average. This mathematical friction means the majority of an intraday cycle is finished before the indicator registers the change in direction. We'll stop the replay at this midpoint. The price is already high, yet the indicator lines are just beginning to move toward a crossover. Intraday momentum cycles typically last 5 to 10 candles. Since the average is just now triggering, the move has passed. Let's reconstruct the trade. On the left, we'll keep the default 14-period setting. On the right, we'll reduce the math to an 8-period lookback and remove the smoothing. The signal on the right captures the momentum shift 4 candles earlier than the default. Shortening the lookback period and removing the smoothing average aligns the indicator's reaction time with the actual frequency of the price candles. Adjusting these parameters helps ensure it's in profit exactly when the delayed signal on the left finally triggers a buy. The uncalibrated signal enters at the move's end, suffering an immediate drawdown as price reverses. This chart highlights a necessary trade-off. Reducing lag increases sensitivity, creating more whipsaw signals, reversals that trigger then immediately fail. These premature signals are the cost of speed. Professional calibration balances timely entries against the probability of false positives. To calibrate for intraday trading, identify the current market cycle, reduce the look-back period to match that cycle, and cut the smoothing average to minimize signal delay. Technical indicators are mathematical derivatives of price. Success in a fast-paced market depends on aligning the speed of your calculations with the speed of the price action itself.